Analyzing stock valuation. As an investor, you may find it challenging to determine the true value of a stock, but four financial ratios can give you useful insights. Price to book, P, price to earnings, P, ratio earnings to growth, PEG, and dividend yield can help you assess a company's financial health and growth potential. By analyzing these metrics, you can identify undervalued or overvalued stocks and make more informed decisions. These ratios are widely available on most trading platforms, making them easy to use for evaluating investment opportunities. Understanding the price to book, B, ratio in stock valuation. The P ratio is most valuable for investors who prefer a conservative approach. This ratio compares a company's market value to its book value, which is the worth of its assets if they were liquidated. The P ratio is particularly useful when evaluating companies in mature industries. These don't generally have rapid growth, but they have significant value in what they own: equipment, buildings, land, and anything else that can be sold, including stock holdings and bonds. Essentially, if all else goes wrong, how does the price stack up against its worth? To calculate the P/E ratio, you divide the stock's market price by the book value per share. A low P/E ratio, typically below 1.0, suggests the stock may be undervalued since the market price is lower than the company's book value. However, you should be cautious if you see a low ratio. A low P/E ratio could indicate problems with the company's assets that other investors know about, which is keeping its price down. In addition, sectors have different normal P/E values from each other. In the financial sector, lower P/E ratios near 1.0 and lower are normal given their assets, and the stock valuation can fluctuate with the market prices of the assets financial institutions hold. Meanwhile, in the tech sector, intangible assets like intellectual property can mean a much higher P/E ratio might be acceptable. Below is the aggregate P/E ratio for the S&P 500 since 2010, decoding the price to earnings P/E ratio. A key metric in stock analysis, the price to earnings P/E ratio is the most used financial ratio. A stock can increase in value without significant earnings increases, and the P/E ratio tells how much investors are willing to pay for $1 of earnings. But without earnings to back up the price, a stock should eventually come back down. The P/E ratio is calculated by dividing a stock price by earnings per share, EPS. The result is the amount investors are paying in the market for each dollar of the company's earnings. A high P/E ratio indicates that investors are paying a premium for the stock, expecting significant growth in the future. Meanwhile, a low P/E ratio suggests that the stock is undervalued or that investors are pessimistic about the company's prospects. It's important to underline that you should only compare the P/E ratios of companies within the same industry and market. Different sectors have varying growth rates and market conditions, which will influence their P/E ratios. For example, technology companies often have higher P/E ratios because of their rapid growth potential. Prices might be higher now, even as earnings are low, because investors expect earnings to increase significantly over time. The price to earnings growth PEG ratio. Precision in stock valuation. If we can compare the P/E ratio to a reliable compass that helps direct you in an often unclear financial landscape, the P/E ratio is like a GPS that gives you greater precision and a more three-dimensional view of the financial value of a stock. This metric takes the P/E ratio and factors in a company's expected growth rate based on its previous earnings. Using the P/E, you not only can pinpoint the present valuation of the company but also see ahead to map where it's going. The P/E ratio is calculated by taking the P/E ratio of a company and dividing it by the year-over-year growth rate of its earnings as an estimate going forward. The lower the P/E ratio, the better the deal you are likely getting, given the stock's estimated future earnings. Suppose you are interested in company AB, which has a P/E ratio of 25, Analysts covering the stock agree that AMC's anticipated earnings growth is 10% in the next 5 years. The P/E ratio is therefore 25:10 or 2.5. By comparing two stocks using the P/E, you can see how much you are paying for growth in each case. A P/E of 1 means you are breaking even as long as the company's growth continues. A P/E of 2 means you are paying twice as much for projected growth over a stock. With a P/E of 1, you will want to supplement the P/E ratio with other stock analysis and ratios. You should also include qualitative factors such as the company's competitive advantage, management quality, and industry trends to better understand a stock's investment potential. The P/E ratio is a valuable tool, but it can lead you astray because it can't account for market conditions, industry trends, or the company's management. To continue our metaphor above, using the P/E alone would be like using a GPS to tell you where to go but not looking up at any point to see if the tool is reliable. Dividend yield. Maximizing returns through income. It's nice to have a backup should the price of a stock you own falter, limiting your upside when you sell it. This is the reason, besides regular payments, why dividend-paying stocks are attractive to many investors. 7. When prices drop, you get distributions. The dividend yield shows how much you make in dividends for the price. You get a percentage by dividing the stock's annual dividend by the stock's price. This tells you how much cash you can expect to receive for each dollar you invest in the company at the present stock price. For example, if a company's stock price is $100 and pays an annual dividend of $5 per share, its dividend yield would be 5%. When evaluating dividend yields, you will want to assess whether they are sustainable and are expected to grow over time. As with the other financial ratios above, you don't want to rely on dividend yield alone. Some further points to consider when using this metric: high yield traps. A high dividend yield could indicate a strong company on a good trajectory. However, it could also signal a struggling company with a falling stock price. If a firm's dividend remains the same, its dividend yield goes up as its price goes down, and often the prices could drop significantly since the last dividend was declared. Always explore the reasons behind an unusual yield. Dividend stability. Companies often cut or eliminate dividends when financial issues or an economic downturn occur. You will want to confirm that the firm has had a stable pay ratio and consistent earnings to support future dividends. Limits to growth. High dividend-paying companies have less to reinvest in their development. This might limit the stock price's ability to appreciate compared with firms that put profits back into the company to grow. What is considered a good P/E ratio? What is considered a good or bad P/E? The ratio depends on the industry in which the company is operating and the overall state of valuations in the market. Generally speaking, a P/E ratio under 1.0 is considered optimal since it indicates that an undervalued stock may have been identified. However, some investors assessing the P/E, the value of a stock, may choose to accept a higher P/E, the ratio of up to 3.0. What is considered a good P/E ratio? Again, this depends on the industry of the company in question, but as rule of thumb, the lower the P/E is, the better. A good P/E ratio should also be lower than the average P/E ratio, which is between 20 to 25. What is considered a good P/E ratio? In general, a P/E ratio is considered to be good when it has a value lower than 1.0, suggesting a stock is relatively undervalued. A P/E of 1.0 is a fair value. It's priced in line with the expected growth. Over 1.0, and you were paying for more growth than expected. The bottom line, using a combination of P/E, P/E ratios, and dividend yield gives you a complete view of a company's financial health and growth potential than relying on any single metric alone. These ratios, along with other financial indicators, can help you evaluate whether a stock is undervalued or overvalued.